Hey, good morning. This is Chris, Suarez Home and Finance, Coffee with Chris. Monday, 10 o'clock. Looks like we're about 2 minutes late. So we're going to talk about interest rates today. So what do they mean? What does it have to do with all of the above stuff? So their interest rates are definitely going up. Probably one day in the last week or so, I saw them, just a notification that I had say that it went down just a little bit, but not a lot. So the interest rates are definitely going up. Are they going up to the 7/8 and all that kind of stuff, whatever, right now? No. Can people will say, well, I'm going to hold off on buying right now because I'm going to wait for the interest rates to go lower. There's nothing indicating that I have seen, and I'm not, I don't have the crystal ball, but there's nothing that I have seen that says that interest rates are going to go lower. So definitely buying or owning a home is better than and cheaper than renting, and you are still making the biggest investment of your life. So it's still the biggest thing that you have. Our interest rate's going to go lower. Nothing is indicating that right now. Have they gone up to extremes, as far as like, have they jumped from 4% to 6% overnight? No. In the grand scheme of things, not really, but they have definitely gone up at a good pace to where right now, rates are in the fives and sixes. And it just depends on your situation. And so that's what we're talking about today. So a lot of people will call and say, what is my interest rate going to be? Well, for me, when you are, I'm trying to get my presentation up here. When you are talking about interest rates, so if you call me on the phone, then it's going to here. Oh, now I'm gone. Oh, there it is. Okay. When you are talking about interest rates, people will call and say, well, what is my interest rate going to be? Well, that's not something that I can just give you right off the cuff. There's too many different variables. If you are calling somebody and they are giving you an interest rate right then and there, and they don't have your whole scenario, your interest rate is not going to be accurate. You're going to be, you're possibly going to be blindsided at closing or throughout the process. Or if you're getting pre-approved and you've got somebody's giving you an estimated rate today, then once you find a house and you get going, or you finally get going on refinancing, then your interest rate could change because now the exact scenario is there. So it's very, very important that whenever you are asking for your interest rate, that you're not just jumping, that somebody's just not giving it to you just off the bat. I could go online and look for interest rates and say, okay, well, a couple of the bigger ones that you see on TV all the time, that's under one company name, but then another company name because they're a subsidiary. So, off to the moon. So if you go on to those different websites, it'll give you an estimated interest rate. And if you read the fine print, it's got a couple of points, but that is based on X score, X dollar amount, so on and so forth. So again, very, very important. So if somebody's asking me and then they say, well, I saw the interest rate of this. Okay, well, let's stop for a minute. Let's go online and look. And I'm going to go to two different places and say, okay, well, this one is saying, this interest rate for these points. Usually I'm not those points, but if you want to pay those points, okay, well, then I guess you're going to have to go to that, bank, because I don't think that it is financially sound for you. And that's what I look at, is what is financially sound for you. So let's get into this. So as far as, so what dictates your interest rate? So several things. So your credit scores dictate your interest rate. What is your scores? Is it a 620, 640? So scores go in groups of 20. That is kind of like the tiers. So used to, if you had a 660 or above, then you were a pretty good rate. Now the realm, or the criteria, so to speak, the guidelines, so to speak, excuse me, is about 680 to 700. So yes, we still do those lower scores, absolutely. But where you're going to start seeing the more benefit is the 680s to 700s. So scores are so important. It can be as simple as that you have credit cards and you pay them down 30% below the limit. For example, we went overseas. I used a credit card over my limit by only $35. It dropped my credit score by 56 points. That is huge. On the same token, I took 4 credit cards and I paid them down below 30%, and my score went up by 100% or by 100 points. So that was huge too. So credit is a dates and a numbers game. You go by the statement date, you go by your limit, and 30% below your limit. That's what you have to look at. Credit cards affect your scores the most. So if you are installment loans, yes, those affect your credit, and yes, you need to have some or whatever. But if your scores are on the lower side just because you've not done anything, or your credit's been stagnant, the quickest best way to do is to have a credit card and to, again, 30% of your limit, not more than that. So I always say leave a $5 or $10 balance, because if you zero it out, that could hurt you as well. If you close out credit cards, that could hurt you. So those are just quick little things or whatever as far as credit scores go, and the importance of that. The next is loan type. So your loan type absolutely matters. You may call Joe Blow and say, hey, what is my credit score going to be? Okay, well, they're going to say, they may say, okay, how much money do you have to put down? Okay, I've got 3%. Okay, well, then they may put you into a conventional, or they may put you into an FHA, which is 3.5%, just depends on your money. But again, your loan type matters. Your VA and FHA, your rates are going to be lower, and USDA is in that realm as well. Those are going to be lower than a conventional rate. Everybody wants conventional, which, yes, if you qualify for it and you have the money and you have the credit and everything else, absolutely. So your first loan type is always VA. VA is the top of the food chain or whatever. It is no mortgage insurance. It is 0% down. If you have, unfortunately, at least 1% of disability, you are exempt from the funding fee. The rates on a VA are better than all of the other ones. Then the next one in pecking order is conventional. Conventional, the rate is going to be a little bit higher, but on conventional, depending on your money down, you may have mortgage insurance if you put less than 20% down, but you only have the mortgage insurance until you have enough equity. So you don't have it over the life of the loan. Again, that rate may be higher, but again, this all dictates your rate. If you are putting down only 5% or 3% on a conventional versus 15 or 20%, that affects your rate. You are putting less money down, so you're riskier because you have less skin in the game, so to speak. You have less investment, so you are riskier. You do have mortgage insurance, monthly mortgage insurance on a conventional loan. So again, all of those things take into consideration. So your pecking order is going to be VA. When you talk to somebody and you know what you're looking for, if you're calling me and you're looking for, okay, what is the rate? I'm going to say, okay, well, let's stop for just a minute. What is your credit score? Where did you get it from? How much money do you have down? Are you looking at a single family or manufactured? So I'm looking at all of those things, and all of these things are just a preliminary. It's not an exact, and it's not going to be until I have everything in front of me. You may think that your credit score is a 700 on Credit Karma, but whenever I pull it, it's a 650. So there is a difference. You may think that FHA is the way to go. Well, no, if you have 3% down and you can qualify for conventional, then you want to go conventional. Again, it just depends on your scenario. How much money do you have? Do you have seller concession, which are limited, which are very little right now. So all of these things matter in your interest rate. If you have less money out of pocket, so if you have less money in your hands to put towards a house, then we may have to increase your interest rate to give you a little bit more of a credit back towards your closing costs. It's called a lender credit. We used to do it all the time. With rates higher now, it's not as prominent, relevant. It's not as much. It's not there as much anymore. So I can't help people as much as I used to whenever it comes to the interest rate. But it's still my job and my mindset or whatever. I am looking out for what's best for you. I'm looking to see what the rates are, what that cost is. Is it going to help you or is it not? What monies do you have? All of those different things. Again, tons of variables. So your loan type, again, that totally matters. Your loan amount. So your loan amount is whether you're buying a house for $300,000 or let's say for $150,000. $150,000 loan amount is going to be a higher interest rate. The bank is not making as much on the loan over the life of the loan versus a $300,000. So your interest rate is going to be higher if your loan amount is less. So that is a given. That is normal. That is all of my years, all of the above. So your loan amount does matter. Your property type. So your property type. So let's say, for instance, you're buying a single family home versus a manufactured, which I'm going to show you an example in a few minutes, but that totally makes a difference. A single family is on a concrete slab. It is on the ground. It is, more secure, whatever, and all of that than a manufactured home. There's also what's called a modular home, which is a manufactured that is permanently attached with a concrete foundation. So a manufactured home is not on a permanent foundation like a single family, so it's riskier. So your interest rate is going to be higher. That matters. So I may pre-approve you for a single family today, and then all of a sudden I've got a contract, which this has happened before. All of a sudden I've got a contract for a manufactured. So I pre-approved you for a conventional 5% down single family today, but you found a manufactured. Wait a minute, your interest rate increased, your closing cost increased. You went from a single family to a manufactured, so the risk increased. And now I have to switch you from a 5% down conventional to a just over a 5% or whatever the math is or whatever. Possibly in this scenario that I had a 20-year conventional because the whole scenario, I couldn't get it as a 30-year. So that's what I do. That's what my staff does. And so again, everything matters. A single family versus a manufactured absolutely matters. Your down payment, which I just touched on that. So if you are putting, again, so VA is 0% down, it is what it is. FHA is 3.5% down. Again, it is what it is. But if you're putting less down than, or a little bit more down, then that could affect your rate too. That could be better, but normally not in the grand scheme of things for FHA. USDA, same thing, 0% down. Conventional is where it really matters on the down payment. It can totally matter versus whatever your down payment is versus, if you're doing 5 versus 10 or 15 or 20% down, totally makes a difference. So that's just a quick, not a quick, but, just a where the differences are. So go into, let's do an example. So I didn't put rates on here per se because rates change all the time. Rates, you have to look at the APR and everything else. So legally, if I post a rate, then I have to have the APR, so on and so forth. So I didn't put rates here just because that's that a little bit. I want to show you the backside of things because, again, everybody's rate is going to be different. So, for example, if we were looking at a single family residence, the purchase price is $300. If you're at a 640 versus a 700, 10% down, your interest rate could be a difference between 3/4 to a point difference in interest rate. So that means that, for example, if your score is a 640, your interest rate could be, say, 6.25. If your interest rate is 700, your interest rate could be, if we're saying 3 to 3, if it's a difference of 1 point, if you're saying 6.25 on a 640, it could be 5.25 on a 700. That's a big difference. And so that's where the difference is in rate. That's what a big deal that it makes. And so that scenario is on a conventional because, again, VA, FHA, and USDA are not as big of a difference on what your rate is or what your down payment is. So that is a huge difference just there with your credit score. Same scenario. Again, single family, 300, blah, 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 so on and so forth. But your difference is the between 3/4 to a point in the interest rate alone. So again, very, very, very important. So our next example is single family versus manufactured. So we're going to assume a 700 score. We're going to assume 10% down. Your difference in the rate is about 3/4. Again, that makes a big difference. So you take that 3/4 of an interest rate over 30 years, that could be thousands and thousands, like well over 10,000 plus or whatever the math is. So again, it's very, very, very important where that comes from. Next, we're going to go to so people think that 1 point equals 1% in interest rate. So if you pay a point, does that equal 1% in rate? It does not. I don't know where the perception came from. Just, people think it's 1 for 1. It's not. So for an example, so if you're at a 650 or a 6.5 rate, then it could be, say, for instance, 0 points. For 6 1/8, which is a little bit lower, so that's lower on the interest rate. So 6 1/8 could be at 1 point. So again, you're going 6.5 to 6.125, and it's costing 1 point difference. So that's not 1 for 1. That is what 0.375 is the difference in rate for 1 point. So don't ever think that that's what it is. So rates have what I call a sale of the day. For instance, this is just, I talk in layman's terms. So that's what I call. So sale of the day means you may have, for your scenario, a 6% rate may be 1 point, but a 5.75 may be, normally it would be higher in points because you're buying the rate down. But so if that 6%, now I got to go backwards. So if the 6% rate equals 1 point today, but a 5.75 may equal 1 1/4. Okay. So that I'm sorry, 0.75. So that means that lower rate is sale of the day. So that lower rate may cost you less because that's what the bank is promoting. So again, it's not always that you buy down to get the lowest rate, so on and so forth. Yes, that is the normal thought process, and that's the normal deal. But there's more to it than that. And so if rates are on, what I call sale of the day, so that's why I'm looking at rate ranges. I'm never looking at one rate, because I could possibly get you a lower rate for less cost or the same cost. So again, depends on what, as I call it, sale of the day is. So again, that's what I do, but it is important of, what you're doing. So people will call and say, okay, what's my APR? Well, APR, when people say that, I'm like, okay, why are you asking me this? So you heard it from someplace. Somebody told you, find out what the APR is, blah, blah, blah. So your APR is not your rate that you're making payments on. So I've posted here, this is what the CFPB says, what the APR, what the actual definition is. So my translation is that the easiest way for me to explain it to you is if you take your loan amount plus your closing cost divided by 365 days a year for 30 years, that's what your APR is. Okay. But whenever you make extra payments, whenever, all of those different things or whatever, well, not all of those, but just if you make an extra payment, that APR is going to now reduce, because now you have reduced your term less than 30 years, so on and so forth. So that's going to benefit you. So that's going to bring it down. That's not what you're making payments on. You're making payments on your note rate. So if your interest rate is 5.5, that is what you're making payments on, not the APR. So again, APR tells you, do you have points? Do you have this, that, and everything else? But depending on the loan type, your mortgage insurance, like FHA, you have the mortgage insurance premium, or VA, you have the funding fee. That is included in your APR. So that's not a matter of points. So you can't go that 5.5 is going to be a 6% APR because of your points. There's more to it than that. There's your title settlement fee. There's appraisal fee. There's your mortgage insurance. There's more that's included in that besides just points. So that's why whenever you're asking APR, why are you asking me? Tell me why you're asking me so I can tell you what it means and give you, have your thought process the right direction instead of thinking that it means something that it doesn't. So that is what an APR means. Let me see. Here we are. Okay. So bottom line, call me. Call my office. We're going to get you going. We're going to get you figured out. So you want whoever's doing your finances to be knowledgeable, to not give you a rate just off the cuff, to actually look at your scenario and see what it is. So I'm going to go back a little bit and recap or whatever. So on credit scores, we know that dictates and everything else. Credit scores go by the 20s. So if you may have a 695 score, I may be looking at your credit and saying, okay, pay that credit card down below 30%. And so we can get you to a minimum of over 5%, not a guarantee, but it normally works because again, it's going to save you on your interest rate and your closing cost. Loan type. Again, it goes based on what monies you have, what your credit scores are, all of that kind of stuff. So your loan type is not just cut and dry. If you are military related, your first option is going to be VA. You need to look at that first to see if that is the best benefit for you, and then you go from there. If you are not military related, then I start at conventional. What money do you have? Do we need to go FHA because your credit score, whatever the case is? So that's where we're looking at. Loan amount. How much money do you have? Because again, you have to remember, you're not only putting down payment down, but you also have to have closing costs. So do you have, if you've only got $15,000? Well, we have to pay for closing costs. So what are those closing costs estimated versus what your down payment is, and what monies do you have? Are you going to have to get a gift? Do we need to look for down payment assistance? Do we need to ask the realtor for seller concessions? All of those things matter, and they dictate your loan type, which dictates your rate. Property type, again, single family versus manufactured. It absolutely matters, and it does affect your interest rate. Down payment, again, we just talked about that. Absolutely does affect. So we did the example there. So again, 1 point does not equal 1%. So get that out of your head. If you do call me and you may say to me, well, which I just mentioned it or whatever, I've got an interest rate of so-and-so or whatever. Okay, let's look at this because we're going to look at the grand scheme of things. So let's say, for instance, if you went to a big box lender, but whatever you want to call them, whatever, a retail lender that you see online. So if their rate is a difference with their rate or their cost, mostly their cost, if their cost is a difference of, let's say, for instance, 0.25%, why would you not have somebody like me to do your loan, and you talk to somebody that you have and that is looking at that instead of being in a call center? So look at those things whenever you're talking to, who's doing your financing. Do you want somebody that is a person that's looking, or do you want somebody in a call center that they may not be looking at the same things? I have a license. License says I have to have morals and ethics. Not that anybody doesn't. That's not what I'm saying. But you want somebody that's going to, look at your stuff and look at it with a good, with good intention, with good, what's going to be the best for you and your family. Again, biggest financial responsibility or, purchase that you're ever going to make. So you want somebody that's going to look at things. So look at who you're looking at. Again, everything matters. Let me see. We already talked about that. So APR. Okay. So CFPB. So APR, we've already explained that. Again, if you've got any other questions, just, feel free to call. CFPB, again, I put that, their exact, on there. So my last item is extra payments. So again, you've got your interest rate. So sometimes theoretically you may think, okay, so say for instance, on a car, you may have a higher interest rate and you're okay with that because you're going to make extra payments. Okay. A car, you cannot write off interest. A home, you can. So if you know that you're going to make extra payments, then sometimes it's okay to have a higher interest rate. Or if you know, okay, I'm in the military, I'm only going to be here for 4 years and then I'm getting restationed. Or I'm planning on retiring in 5 years, whatever the case is, you may be okay with a higher interest rate because that's going to be less money out of pocket because you're there short term, or again, you're going to make extra payments. So those are things that we're looking at too. So if you are, when you have a mortgage, number one, you can write off some of the closing costs whenever you do your taxes. Number two, you can write off your property, and that's only the first year. So if you close in 2022, then whenever you do your taxes in January of 23, then you can have some write-offs. On your taxes every year, you can write off your mortgage interest and also your property taxes. So again, your accountant is going to do that, but that's what I do every year. That's what we do. So so with your rate, okay, so again, it depends on the rates and everything else. But if you make one extra payment a year, whether it is biweekly, some people think that it's better to do biweekly. That's up to you. But some banks, you cannot make a payment biweekly. So let's say, for instance, you make it, whether it's biweekly, whether you make an extra payment monthly, whatever the case is, if your principal and interest is $1,000, okay, that's including interest. I always just have that, and it's an extra cushion anyway. So if you make one extra principal payment a year, it can take off about 5 to 7 years off your mortgage. So again, whether it's biweekly, whether it's monthly, whether it's several times over the year, if you do it at least one time a year, it'll take off about 5 to 7 years off your mortgage. So whenever I go to closing, there's what's called the total financed amount. So that total financed amount, a lot of lenders, a lot of title companies, a lot of people say, well, we're going to skip right past that number. I do not. That is your come to Jesus. That is a, oh my God, your sticker shock or whatever. If you never make any extra payments, that's really what you're paying for the house. So you need to make those extra payments. So all of that matters. Your interest rate, again, we're talking about interest rates. That totally, matters in all of that. That is going on in all of those numbers. Your closing cost, everything is included in there. So that's just that totally matters. Make an extra payment if you can. Again, mortgage interest you can write off, car insurance you cannot. So you want to make extra payments first on your vehicles, get that paid off, but then sock every bit of money that you can to your mortgage, at least one payment a year, principal. So there is my office numbers. If you'd like to call, we can do a loan consult, and you can talk to my staff, and they are versed. And if they've got any questions, they know that they can reach out to me. They know they get me on the phone, whatever the case is. You may have a hard scenario. We just don't know. Self-employed is not just a cut and dry thing or whatever, but we're here to help you. And but if you got just a general question and you've got somebody else to do your financing, I'm always open to call me, ask me the questions. I'll at least educate you and tell you my opinion, and then you take it from there. So this is all my contact information, which is all over everywhere. And we're going to be posted on all social media, YouTube, all of that. And so I want to thank you so much for coming and watching Coffee with Chris Monday at 10 o'clock every Monday. So I hope you have a great day. Talk to you soon. Don't make it a typical Monday. Make it a great Monday. See you later.